Greetings, savvy traders. We're thrilled to have your attention today. Your unwavering support and active engagement are the driving force behind our content. We humbly request you to hit that like button and help us grow this thriving community of market enthusiasts. Today we are going to explore the intricate nuances of three powerful tools in stock analysis: the relative strength index, Bollinger Bands, and the moving average convergence divergence. Without further ado, let's delve into the fascinating world of stock trading indicators. First on our list is the RSI, or Relative Strength Index. Now if you're scratching your head thinking, what in the world is that? Don't worry, we've got you covered. Think of RSI as a handy tool in your stock trading toolkit. It's a momentum oscillator that measures the speed and change of price movements. In simpler terms, it tells you how fast and in what direction the price of a stock is moving. Here's how it works. The RSI oscillates between 0 and 100. If the RSI of a stock is above 70, that's usually considered overbought, meaning the stock might be getting overvalued and could be primed for a price pullback or even a price reversal. On the flip side, if the RSI is below 30, the stock is considered oversold. This could indicate that the stock is undervalued and might be due for a price bounce back. But here's the kicker. Just because a stock is overbought or oversold doesn't mean the price will immediately reverse. Remember, the stock market isn't a predictable beast. It's driven by a multitude of factors, from economic indicators to investor sentiment. So, while the RSI can provide a snapshot of potential overbought or oversold conditions, it's not a crystal ball. It's also worth noting that the RSI works best when used in conjunction with other technical analysis tools. So don't put all your eggs in the RSI basket. Use it as part of a broader strategy to make more informed trading decisions. In a nutshell, the RSI is a measure of market momentum. It helps traders identify potential overbought or oversold conditions in a market, providing an insight into possible future price movements. But remember, as with any trading tool, the RSI should be used wisely and always in conjunction with other indicators. So, that's the RSI for you. A simple yet powerful tool to gauge market momentum. It's like the compass in a trader's navigation kit, guiding you through the choppy waters of the stock market. Next, we turn our focus to Bollinger Bands. Now, imagine a trio of lines snaking their way across your stock chart. These are not just any lines, these are the Bollinger Bands. But what exactly are they? Well, Bollinger Bands are a volatility indicator that consists of not one, not two, but three bands. You see, the middle band is like the heartbeat of the market, pulsing along with the simple moving average. Now, flanking this middle band on either side are two outer bands. These aren't just hangers-on, mind you. They play a crucial role in showing us the volatility or the ups and downs of the market. When the market gets a bit too excited and volatility increases, these outer bands stretch apart like a rubber band being pulled. But when things calm down and volatility decreases, they move closer together, like that same rubber band relaxing back to its original shape. Now you might be wondering, how can I use these bands to my advantage? Well, that's where the magic happens. Traders use Bollinger Bands to identify potential buy and sell signals. When the price of a stock hugs the upper band, that's often a signal that the stock may be overbought. On the flip side, when the price is cozying up to the lower band, that could be a signal that the stock is oversold. But remember, like a weather forecast, these bands are not a surefire prediction of what's to come. They're simply a tool to help you understand the market's mood swings and make more informed decisions. In essence, Bollinger Bands are a bit like the mood rings of the stock market. They change and adapt, reflecting the market's emotional state. And by learning how to read these bands, you can start to decode the market's behavior and navigate its peaks and valleys with more confidence. That wraps up Bollinger Bands, your go-to indicator for understanding market volatility. Last but not least, we have MACD, or Moving Average Convergence Divergence. In the world of stock trading, the MACD is like a compass, guiding traders through the volatile seas of the market. To put it simply, MACD is a trend-following momentum indicator. It's a tool that helps traders understand the momentum behind a security's price movement, whether it's gaining steam or losing pace. Now, you might be wondering, how does it do that? Well, the MACD shows the relationship between two moving averages of a security's price. Picture two lines dancing around each other on a graph. One line represents the short-term moving average, while the other represents the long-term moving average. When the short-term average crosses above the long-term average, it's considered a bullish signal, suggesting that it might be a good time to buy. On the flip side, when the short-term average crosses below the long-term average, it's considered a bearish signal, indicating that it might be a wise time to sell. Additionally, the MACD generates a third line, known as the signal line. This line is a 9-day exponential moving average of the MACD itself. When the MACD crosses above the signal line, the market is considered bullish. Conversely, when the MACD crosses below the signal line, the market is considered bearish. But remember, the MACD is not a crystal ball. It won't predict the future, but it gives you a sense of the market's momentum. It's a tool that can help you make informed decisions. And here's the beauty of it. MACD can be used in conjunction with other indicators. For example, you can use it alongside the Relative Strength Index or Bollinger Bands to get a more holistic view of the market. In essence, the MACD is like your reliable friend in the stock market, always there to give you a nudge when the trends might be about to reverse. And that's MACD for you, a reliable friend for spotting trend reversals. Now that we've covered the basics, it's time to see these indicators in action. So, you've got your RSI, Bollinger Bands, and MACD at your fingertips and you're raring to get started. But remember, these are not crystal balls. They're tools to help you make informed decisions. Let's see how they can work together. Picture this. You're eyeing a particular stock. The RSI dips below 30, indicating the stock may be oversold. This might be a good time to buy, right? But hold on. Don't rush in just yet. Let's bring in the Bollinger Bands. The stock price is touching the lower band. This could indeed be a potential buying opportunity. But let's confirm this with the MACD. The MACD line crosses above the signal line, suggesting a bullish trend. Now, with all three indicators pointing towards a possible upswing, it might be a good time to make your move. But here's the important bit. These indicators should be part of your wider trading strategy. You need to consider other factors, such as the stock's fundamentals, market trends, and economic indicators. Over-reliance on technical indicators can lead to tunnel vision, and that's something you want to avoid in trading. Now let's flip the scenario. The RSI is above 70, hinting the stock may be overbought. The price touches the upper Bollinger Band, suggesting it's trading at a high price. The MACD line crosses below the signal line, indicating a possible bearish trend. With all three signs indicating a potential downturn, it might be time to sell or short the stock. But again, don't rely solely on these indicators. Consider the wider picture. Look at the company's earnings report, industry trends, macroeconomic data. Diversify your portfolio to spread the risk. Remember, these tools are not infallible, but they can certainly give you an edge in the trading game. Use them wisely. They can help you spot potential opportunities and pitfalls, but the ultimate decision is yours. Happy trading! Well, that brings us to the end of our journey through RSI, Bollinger Bands, and MACD. We've traveled a long path, covering a lot of ground, and I hope you found it as enlightening as I have. Let's take a moment to reflect on what we've learned. We started with the Relative Strength Index, or RSI, a momentum oscillator that can help us identify when a stock is overbought or oversold. It's a handy tool, but remember, it's just one piece of the puzzle. Next, we explored the world of Bollinger Bands, a volatility indicator that can give us a sense of how a stock's price is moving relative to its past performance. These bands can help us spot potential price reversals, but they're no crystal ball. They give us a lens to view the market through, not a surefire prediction. Then we delved into the Moving Average Convergence Divergence, or MACD, a trend-following momentum indicator that can reveal potential buy and sell signals. It's a powerful tool, but like any tool, it's only as good as the trader who wields it. These indicators are vital for understanding the ever-changing landscape of the stock market, but they're not infallible. They're tools in your trading toolbox to be used wisely and in conjunction with other information. Thank you for joining us today. Don't forget to hit the like button if you found this video helpful. Until next time, happy trading.